Good morning and welcome to what I'm watching this week for the week of 13 March 2017. Please feel free to visit us on dreadheads.net or at drcwealthmanagement.com for the full written version of what I'm watching this week. So now, let's get into it. The FOMC meetings, otherwise known as the Fed meetings, are occurring on Tuesday and Wednesday. We'll get more into that here as we move through this video. But looking back at the bull market that we're in, Thursday of last week, the 9th, marked the 8th anniversary of the current bull market. It's the second longest on record. Back in 2009, the S&P was traded at 677. Now it stands at about 2365. That's reflecting a price gain of an astounding 250%, or basically 17% annualized, 19% annualized with dividends. It's a pretty good deal, pretty good birthday, wouldn't you think? As of last week, Wall Street held on to some modest gains as support from the bullish jobs report. The S&P 500 on Friday closed higher on the 235,000 increase in U.S. non-farm payrolls. It was stronger than the expectations of 200,000, and that also coincided with a mildly higher close in June T-note prices. Friday's closes on the S&P were up 0.33%, Dow Jones was up 0.21%, NASDAQ was up 0.41%, and the Russell is something to be paying attention to. The Russell closed down 2%. It's a cautionary technical indicator, but certainly something we should pay attention to. Also, on the downward side, the market gains that we did experience last week, they were all countered by the lower crude prices. Crude ended the week under 50, ended at 49 and some change. Soybean, corn, wheats, they all closed the week lower. Futures in all three of these markets are struggling on the price charts. Again, piece of caution to pay attention to. Gold finished the week slightly higher. Over in Europe, the Europe stock market climbed to a 15-month high on upbeat comments from Draghi, ECB President Draghi, who said that the risks to growth are more balanced as the economic outlook in the Eurozone has improved, which kind of says a lot, I'm sure. In Asia, stocks settled mostly higher. Japan was up, Hong Kong and China were all up. India was closed on Friday. Going back to the Fed meetings on Tuesday and Wednesday of this week, we're expecting to see a rate increase of 25 basis points. That should take us right to 75 basis points that we've seen in the last two raises. And it keeps them on track for their target of 1.4% rates by the end of the year. That would be a substantial increase over the last number of years. So again, a little bit of caution. The chances of the actual possibility of this rate increasing is happening. It's probably about 90%, and the market's already started to price some of that in. That you've seen some downtrends in the market, and we'll see how that actually hits here as the 15th hits. But again, take some caution. A couple of things that you should be paying attention to and are also very cautionary. The number of stocks that hit the 52 weeks lows has exceeded those that hit 52-week highs for the past 4 weeks. The past 4 sessions, in a row. That's an early technical sign of a downtrend. Another possible thing that's on the horizon, actually two other things that are on the horizon. The debt ceiling, that conversation is going to be getting here in Congress here. That should be interesting how that moves forward. And also the expectation of some tax reform happening in 2017. I personally don't think it's going to happen. And I think as we move further in the year, I think with the schedule that Congress has to deal with right now, I think it's going to be very well known very quickly that tax reform in 2017 is not going to happen. Those are cautionary measures for the market. Going back to the birthday of the current bull market, during the first phase of this current market from March 2009 until April 2011, the markets rallied on the back of a rebound in earnings from the depths of the global financial crisis. Higher profits accounted for 66% of the index's 102% gain, while price-to-earning multiple expansion explained just 17% of the rally. That's something to really pay attention to. The second phase of the bull market has lasted more than 5 years, and has been driven mostly by an increase in valuation rather than the level of profits. The adjusted profit to earning multiples climbed to 18 from 10 times, explaining 71% of the rise in the index. Higher earnings accounted just for 28% of the rise. These are screaming for the technicians out there and the fundamentalists that there's probably something on the horizon here, folks. After the inflation in the profit to earning multiples, the S&P now trades at a 90th percentile of historical valuations relative to its past 40 years. The current consensus of forward profit to earnings of 18 to 1 is the highest level since 1976, outside of the tech bubble. I, for one, believe any ratings above 14 times are kind of illusionary, and I think we're at that right now. That's just my personal opinion. There are basically only two drivers, if you really look at it, to stock performance when multiples stop expanding. One, earnings growth, and or two, expected earnings revisions. Simply put, only higher profits will support higher stock prices because equity valuations will almost certainly be lower. And seeing where we're at 18 to 1 earnings, I don't see how those are sustainable. I don't see how those are technical or fundamentally justified. So again, we've got a couple things on the horizon. We've got the FOMC meetings coming up here this week. We've got the debt ceiling. We've got the continuing bubblings of things going on over in Europe. And we've got our economy. So caution is still on the agenda. I'm not saying it's a risk-off environment. It's still certainly a risk-on environment until we see otherwise. But that's what I'm seeing. That's what I'm watching. I appreciate your time and your diligence in continuing to view these videos. Please feel free to email us or give us a call if you have any questions or concerns. And we look forward to seeing you next week. Thank you for your time.